Hey, good evening, everyone. Welcome to December speaker series. It's great to have you all joining us this evening. For those of you that have not attended in the past, Dirigo Labs speaker series is a monthly event where founders and leaders are able to share advice on how they overcame challenges, capitalize on their target market, and develop their products, providing you with actionable insight for your own products and processes. For more information, you can find us on Facebook or online at centralmaine.org or dirigolabs.org under our speaker series tab. I'd like to thank our sponsors for this evening's conversation. This free event is presented by Dirigo Labs and is sponsored by CGI, Valley Beverage, Thomas College's Harold Alphon Institute for Business Innovation, and Bricks Co-working and Innovation Space. In addition, this conversation is being recorded and will be available for later viewing on our YouTube channel. This evening's conversation is presented by Prospector Portal with Chief Operating Officer and co-founder Jonathan Gotthau. In this speaker series, Jonathan will discuss how Prospector Portal's database contains more than 10,000 mining projects and 2,600 mining companies, producing analyst time with advanced features to find mineral assets, analyze technical reports, and make informed decisions quicker than ever before. For those who aren't familiar with Prospector Portal, Prospector was founded in 2020 by global mining expert Emily King, who created the industry's first searchable digital database with an easily navigable AI-enabled interface that modernizes the way investors and researchers find and use information about the mining industry. And without further ado, I will turn it over to Jonathan.
Sabrina. All right, well, thanks everyone. For those who don't know me, my name is John Hopper. I'm a COO and CTO of Prospector. A little background about myself. I was born and raised in Biddeford, Maine. I live in Waterville. I went to Colby, where my wife teaches, and I worked at IBM for about 7 years. Left IBM after that to another startup called iBuild. And then during the pandemic, Emily was thinking about this new thing called Prospector. So I came along the ride with her, and now here we are. So what is Prospector? So like I say, we're data mining for mining data. And what we do is we take public disclosure documents and we create analytics for those looking to invest in mining and really make it easy to use. I'll talk a little bit more about what Prospector is, but just introduce to our team first. Everyone's a co-founder. And we have Gotham, our head of corporate development, former geologist and investment banker. Also, Monte is a financial analyst that used to work at Anglo American. Tatiana is our main data scientist, head of data science, and just a moment our head of sales. These are some of our customers. So we sell our data off to companies like FactSet. They do a lot of the fundamentals. Every Robinhood trade or something like that. FactSet's the one that provides the fundamental data. We are the mining data provider for FactSet. But we also have a number of mining companies that use that to look for investment as well as other investment banks. Companies like Pinto, HP, and we even have Tesla as a customer who's been using us to using mining analytics. So why should you care about mining investing? Right, that's what I want to kind of start with. I think most people, myself included, never really thought about mining until I got involved. We all have phones, right? Or in the car. So looking at the EV transition, there's going to need to be significantly more metal than is currently available for all of us in order for everyone to have an electric vehicle, to replace their phones, everything. I'm going to talk a little bit about in depth today about lithium, but if you look at it, we need 14 times as much nickel as what we have, 14 times as much aluminum, 13 times as much phosphorus, 13 times as much iron, 10 times as much copper, 10 times as much graphite, 9 times as much lithium, 3 times as much cobalt. Get the idea, right? We do not have enough metal right now to do all the things that we want to do. So when you hear people talk about, oh, by 2030, everyone's going to need an electric vehicle, you need metal to do that. The average vehicle has a hybrid vehicle of about 2 kilograms of lithium. An electric vehicle is 30, up to 63 kilograms of lithium. Think about the demand, what that changes about the markets. At the moment, we produce a little less than 90,000 tons of lithium a year. That means by 2030, we'll have about a little less than 1 million tons of lithium that we can use. Which is, we can get there, but the overall demand, that little sliver. The good news is we have the reserves, we have the resources, we've identified it globally. Problem is, if you look at the difference between supply and demand right now, this is the demand, well, 300,000 tons. And we're supplying about, a little less than 100,000. When we get to 2030, right, we take recycling, even if we take recycling in the context, we are going to need to 10x our production. So even though we have stuff in the ground, we're going to figure out how to get that stuff out of it. Well, we're not going to have enough to do all the vehicles, laptops, cell phones, and everything we've done. McKinsey did a study a few years back where they were looking at, well, how much do we need to invest? When you think about a typical mine, it takes about 5 to 10 years, roughly $500,000,000 to bring production. We should have been spending about $160 billion a year since 2012 to meet these commitments. And we've been shortfalling by about $60 billion. So we're running into a shortage. If we look at the price of lithium over the last year, I think it's gone about 5x, 6x. This is what has to do with the shortcomings of what's out there. So what we do at Prospector is we're helping you to find quality investments, right? And so going into those quality investments, if you want to get involved, you want to support this one, close the gap, maybe you just want to be a retail trader buying into a company. You need to know a few things. So first, right, when we talk about mining, very basically, you take a bunch of ground out, you take some of that ground, you process it a little bit, you get some more, you then refine it, get some concentrate, that concentrate then comes into something that you can use, right? Progressively smaller. There are typically 4 types of mine that we think about, right? There's an underground shaft, usually very expensive, less environmentally destructive, but also can cause some issues if you want to build on top of it later. Open pit is probably the most environmentally unfriendly type, but the cheapest. Placer is what you think about, that's your panic and gold. And then lastly, I'll talk a bit about this later. It's what's called in situ mining. So in situ mining is when you're similar to fracking, you actually put chemicals or water down to the ground, it clumps them a lot, pull out of the ground, makes it a little easier to blend. In some ways, it's more environmentally friendly because you're not moving into the ground, you would with a pit, but it does put chemicals into the ground. Lithium, which we'll talk about, works in a brine where you're actually taking water from the water table, sucking it out of the ground, and then you're filtering it off when you're drying to do the lithium. So we'll talk about this later, but it is important to remember that brine typically is a lot less environmentally destructive than mentioned. Other things you might want to consider, right, when you're thinking about mine, water. There's lots of water involved in mining. You need to consider that source, make sure you're not taking over the populations. Mine waste, right? So you hear a lot about these things called tailings, which are the waste that comes out of the mining process, which often can cause, lots of poisonous things, sneeze, those kind of stuff. Biodiversity are going to affect, plant life, animals, and then emergency preparedness, right? If something goes wrong, how do we make sure that everything's okay? Again, all important things you want to think about beyond the overall economics of the project. So, additionally, right, when we talk about mining, there's really only about 350 to 400 companies globally that actually produce, right? This is when we all think of the conventional mine, the big trucks bring into the plant, the metal that comes out, the Rio Tintos, the BHPs of the world. There are over 4,000 companies who do what we call exploration and development. So these companies, what they're doing is they are looking for the next mine. They're going out and speculating, and they usually sit at a market cap somewhere between 20 and 100 million dollars per year, $100 million market cap. Which is great, right? They're doing this, but because of the economics of a mine, because if I'm a company and I'm valued $100 million, I own a piece of property that's going to take me $500 million to bring to production, I'm never going to raise that cap. So what oftentimes happens is these big producers are looking to acquire these smaller companies. That's to the point where Barrick Gold, the third biggest gold company in the world, last year spent, I think, $40 million on exploration. And they are a, $40 billion market cap company. So what they're doing, instead of doing exploration, looking for things that we see Exxon do in the oil industry, is they're actually looking for the next company they can buy to get them up, right? They're not spending money on actual exploration. And when we look at the life cycle, there's a number of stages you go through. There's some sort of concepts, right? I think there's something here. I drill a bunch of holes, I move into something that's called pre-discovery. I then estimate the amount of ground that I think I can get out. Right? It's the peak value. It's usually one of the peaks when you're working through things. And then what happens is working period, because once I identify the stuff that I want to get out of the ground, And then I'm also identifying how much it's going to cost to do that, right? And if it's cost prohibitive, the value oftentimes shoots down until you can find someone to finance that property. Once it's financed, the value of the mine is considerably, and obviously as you deplete the mine, right, all mines are depletable. The value goes down, and eventually all mines go to zero. And again, the key here, right, the takeaway is the producers, they play over here. You don't really play that often on the other end. The juniors are the ones, small companies, that are the ones doing all this stuff up front. Has a lot of benefits, right? One, it's lower cost for the big mining companies. Two, you're dealing with a lot of permitting and legal issues, dealing with local governments. There's a lot of nuances to this. So it's also very important. And as I walk through, I'll talk about the stages the data comes in, right? But just important to understand when we talk about investing, you can invest in these big companies. These are, you know, the Rio Tintos and the HPs throwing it out. But the junior companies are just as valuable investments. However, they are volatile. There's a lot of risk in them because if you invest in that company, let's say you invest here, not a great spot to be if it ends up there, right? You want to be able to invest in companies on the way up, not on the way down. And it's part of understanding the life cycle of what's happening. And that's what the information that's talked about in these mines is so important. So where do we find the answers to the questions? How do we know what's a good mine? So the number one thing that we rely on is they call technical reports. So for a mining company, there are these technical reports that need to be filed for every mine that they own, right? And anytime there's a material change to that mine, they need to report in these documents. There's multiple standards. The one that we use a lot is in Canada called 4301. The one in Australia is called JORC. And the one in the US SEC uses called SK 1300. These filings are usually 50 to 1,000 pages long. They are very dense. They are very hard to get a person to understand what they're saying. And they cover all business aspects of what goes into building that mine and bringing it to development. You can see here, these are actually sections that exist, right? You can see things like exploration, drilling, data verification, mining methods, recovery methods, capital costs, economic analysis, right? Very confusing, very difficult. Unless you know a lot about the mining industry and you are financial analysts. Other things, right, that are out there, there's annual reports talking about quarterly production, annual production, the cost of that production. There are resource and reserve updates. These are the things that tell us how much ground we think is out there to mine, what confidence level we have, and what percentage of actual metals in there. I'm gonna dig 5 million tons of dirt out. How many ounces of gold am I gonna get out? Right? Mergers and acquisition, who owns what, what's being sold, what's the value of the sale, what's available to do the deal, and exploration, drilling results. This is when you're drilling holes, you're maybe not at the point of actually estimating the resource, but it is telling you a bit about the potential for a resource that may lead to some sort of things. What does this look like, right? So we think about it. Remember that little chart we showed about the stages? You can see at the top right. So this is the drill results. These are what happened just before there's a resource estimate come out. It look kind of like this, a bunch of little spreadsheet. It's got some grades in it. Here you'll see it's like, you know, different grams per ton over certain intervals. It creates these 3D models. See that? And that's basically over the property. And it's telling us what do we think is there, right? Usually, you know, you need to drill a certain number of holes to get you to something called resource estimate. If you look between the two, right? These holes, these drill holes are what relates to that resource estimate. See that little red blob? That's what's telling us how much ore is there, what the rate of that ore is, and how much we need to get out, and how we're going to design a pit to get it out of the ground. All important things to figure out when we're looking at the economics of that model. This right here is kind of a sample of what it looks like. We're usually telling you the tonnage, how much ground is there, the grade, what percentage of the metals in there, and then how much am I going to get out of that metal. The measured indicator referring to the confidence level differences. All you gotta know is measured is really confident, inverts less confident. Once you progress in the resource, eventually you create a business plan. What you're trying to come up with here is like, how much am I going to mine? What's it going to cost me to mine? How much investment do I need up front? What are the risks? How do I discount it? And ultimately, what am I trying to get to my net present value? What is the mine? Is it worth my investment? Is it the best investment I can make? Eventually, then you go on production, if you're trying to invest in assets. This is where you're tracking how much is being produced, how much is being depleted. If the mine is producing more than it's depleting, the value is going down. If it's increasing the reserves faster than it's depleting, right? Faster than producing, that means that the value is coming up. And your value is a relation between how much stuff you still have in the ground versus how much is going to produce from certain production. So, why do we use, and how do we use MLP? How do we use natural language processing and machine learning to address this problem? So, we use something called human-centered AI. And what this is, we take millions and millions of PDFs they get filed with the public exchanges. These companies need to file in order to fall within the regulatory requirements. These documents run through a number of our models. We create summaries of these documents. We create taggings and classifications so we can organize them. And then we create some data collection tasks that are usually done by our analysts that do a little more refinement. Those result in some technical summaries, some advanced filters, and then eventually we're getting to the point where we can tell you, okay, this mine produced this much over this time period at this cost. Now, in order to get to this, though, we have to do a lot of work on how do we pull out metrics out of these reports. And we use kind of a three-tiered process here, where we're using a transformer model. And for those not familiar with transformer models, what they are is essentially they're translating the text. Simplest way to explain it. To look at how the position of the word might change in the sentence. And then you give it a prompt. So let's say the prompt is, who is the author of this document? Or what is the project related to this document? And it's giving us some responses back. So we run this first. And so you can see in this instance, it's talking about street on the right, and it's talking about animal on the left. And that's just because of where it's in the sentence. It's a lot of similar words, but the idea that these models are able to identify what that word is referring to. If I'm seeing it, what's it actually talking about? So if I'm going through lots of text, I want to know what these things are saying. Once we run this transformation, we run it through something called a named entity recognition algorithm. And what this is doing is it's then taking that text that's been transformed and it's classifying it into the types of text that it is. So is it about a person? Is it about a company? Is it about a mineral? Is it about a project? And once those things are done, we then move into something called vector analysis or vector similarity, cosine similarity. And what this is doing is it's looking at the name that we've identified and seeing how close is that to something we already know exists in our database, right? So if it's a project name that we're seeing in the document, do we think that's very similar to another project name in the document or another author that we carry? So one thing that we do, I'll walk through our sample author model, is for every document that gets published as a technical report, let's track who the author is, so that we can see all the reports they've written and see if there's some sort of trend on the type of report that you're finding out. And so initially we get some text from that document that might indicate who the author is. That text gets transformed to look like this. Kind of not very useful, right? There's multiple prompts here asking who's the author, who wrote this document. We're testing that transform model to see what's there. The output of that then goes through an NER, the name entity recognition, and it recognizes, okay, these are the things that I think they're talking about this. Then we run a vector similarity amongst all the authors in our database when we are match. Can. That's how it's mentioned. And so we run this model to run through an entire document to look at who wrote it. This task of just doing this, amongst other things, we early on had to do a bunch of training. This takes about an hour per document of the 20,000 documents that are out there to do this kind of analysis on who wrote it, what the mineral was. Now it takes less than a minute. And what we do is we stack these models on top of each other, right? We combine them together to get a really rich summary and rich information about what the document is saying. As an example, we'll start, we have a model that basically identifies the document. Okay, what section talks about location, what section talks about geology, what section talks about cost, what section talks about the local environment and the infrastructure. And then we pair that with, okay, what project is this talking about? And then we can always check in our database, what do we know about that project already? And then we run through a series of submodels, right? So this instant, our offers model, right? They look at a page like this. Look where Mark is in it, in the top, you can see there. Then maybe it's looking at a mineral estimate. This is what we're looking at for the ore body. This is what this will be pulled out. And then maybe I'm looking at the location. Where is the project located? It's not in our database. Where is it? Where I put it? And how can I either recommend the input to our database or send it to an analyst for review? Then one of the more sophisticated ones I'll wrap up with before we get into actually seeing what this produces is we do this thing where we walk through the documents and we actually try to identify specific tables. Those tables then get mapped to suggested inputs in our database based on key performance indicators that we track. Those go to an analyst for review and they can put it into a database. So one of our big competitors is a company called S&P. They're not familiar with down there. A big competitor of Bloomberg. There's another company. And what those companies do to pull metrics out like this is they actually have thousands of people that sit in the Philippines and India and put a string. That's what they use. We take a bit of a different approach where we use the AI to recommend the inputs, and we put a higher level hands, usually a geologist, someone that's just out of mining engineering school or geology, and they'll review it instead. The idea here is that we're able to do a lot more with a lot fewer analysts by leveraging machine learning methods. So now that we've kind of gone through all that, let's look at a couple projects. So this is Bolchari and the Kachari mines. These are both pre-production. One's located in Peru on the left. One's located in Argentina on the right. The one on the right is a little further along than the one on the left, but fairly similar projects. Ownership structure, right? This is the kind of data we pull back for our users. The one on the left is owned almost entirely by the company. This one is owned 50% by a Chinese company and 51% by a Chinese company, and 49% with a lithium American-based company listening in Canada. We then pull those metrics, a little hard to read here, but what these are all the cost metrics, the life of the mine, how much is going to be mined out of it, all this data. And what's happening here is our models typically recommend this, analysts review it, and then input it in our database. And we're working on training models that you can automate that even further. But the important part is these are all the things you need to create a business case for a model. It's going to tell you how much the mine is worth, how much capital does it need, and what's it going to ultimately give you for value and training. And then lastly, these are the resources and reserves, right? This is how much ground are ready to dig up. Now, just revisiting back, just want to remind everyone, remember we were talking about underground, open pit, placer, and in situ grind. Right, the two mines that we're looking at in Bolchari. Bolchari is an open pit mine. It's important to remember, we take lots of stuff out, usually not that environmentally friendly. And then Kachari is a brine mine where you actually basically digging a hole into the ground and you're sucking the water up, letting it dry to do lithium. A little less environmentally invasive, typically cheaper to put in production. Rarer geologically speaking across the world. Now, I was running a few scenarios. So let's say the price of lithium carbonate equivalent, which is LCE to the top. This is what we need to build batteries. Let's say the price is at $7 a ton. If we look at these two projects, Bolchari is the open pit, Bolchari is the brine. You'll see that on the left side, okay, the Bolchari is going to produce more, right? Well, 4.5 million pounds versus the 3.5 million pounds of Bolchari. Okay, so that means there's more revenue that's going to be produced by Bolchari, no matter what. However, when I look at the mine ore, there's no mine ore for this one on the right because it's a brine, right? But the open pit does have that in the middle, right? So we know that's an advantage for this model because I want to dig less stuff out of the ground. Okay. Process ore, it's a little different because we're talking volume versus mass, right? The mass of ground versus the volume of the water. So kind of equal out there. The open pit is going to take $2.7 billion to take into production. The brine is only going to take $835 million. Then I look at the operational expenditures. We're spending $8 billion to run the mine on the left, and we're gonna spend $5.6 billion to run the mine on the right. Tax rate's higher in the open pit. Tax rate, and then the royalties are higher on the brine, right? And when we take all this stuff and we look at the life of the mine, one the chart is a 33-year mine, this is a 40-year mine. We do the net present value calculation, and that gets us the open pits better, right? It's a better investment. Great, right? But I'm valuing these two things the same, right? I'm not thinking about them as in the environmental impact, right? So how do I do that? How do I think about what is a good mine versus a bad mine if I'm environmentally conscious? So let's say I keep the price the same, and I discount this one less, right? I'm going to say, oh, I think that this one should be discounted less by 2% because it's not having as big of an environmental impact as the open pit mine. When I do that, okay, they're a little even, but that open pit is still 640 million versus 606 million. Maybe I want to still go, maybe I don't, but you know, the economic analysis still say, okay, do the open pit, invest in that. Now, £7, that's what we pay today. I mean, that's what the price of lithium is today. Do we think that's going to be the same over the life of this mine? It's going to forecast 40 years in the future. So then let's say, okay, let's say it's going to be £8, right? What happens, right? Now we're looking at it again, still making more revenue on the open pit, but now the value is 828.6 million versus 995. And now we're seeing that this mine is more valuable because of what we've gone with, right? We know that because we're discounting it, because the price is higher. And so this is what's important to understand. You kind of need all of these things in an easier way to use, right? This is what we do. We try to distill it down. So you can do this analysis on multiple models, right? You can understand what's good and what's bad. In this case, I'm a big fan of the mine get figured out. And that's it.
John, that was awesome. Thank you so much. I heard you speak and pitch, and you're really wonderful. Every time I hear you speak on Prospector, I learn something new. So thank you. Question is about the nature of those technical reports, given the importance of them feeding into your model. What is it ever? How often is there like a technical error or a non-technical error in those reports? And if that's an issue feeding into your model, how do you account for that? And is that where the analyst comes in?
Usually the analyst comes into that case. And so what we'll see a lot of times is we recommend inputs. I mean, the model fails all the time. I would say some of our models are 95%, which is great. Other models are 60 or 70%. Is it ever trained enough yet? And so we do have a lot of that work. I mean, companies also misreport this all the time. Like they'll take, for instance, when you're looking at the ratio in the resources, right? We typically talk about resource. You're looking at, okay, there's this much stuff that I'm going to dig out in storage. There's this grade, right? What's the ratio? And there's this stuff I'm going to take out. I'm going to get out of that, right? The ounces of gold, the pounds of copper. There are conventional ways based on whether you're dealing with a metal that's like what we call precious metal. So if you're dealing with a precious metal, you typically measure things in grams per ton. If you're a base metals, and the precious metal would be gold, silver, and platinum. A base metal like copper, cobalt, nickel, lithium, typically gets measured in percentages. And what will happen is sometimes they'll report the metals in the same table, like they'll have, a lot of times copper and gold show up together, and they'll have a percentage in grams per ton mixed in the table because they misreported. Very common thing. So this is where we have our analysts go through. We have a bunch of automated checks that also run. So once something gets loaded, in this instance with a resource, we'll check the ratio, the estimated contained metal based on the tonnage and the ratio against what they've actually reported. And if those things are more than 10% difference, we have an analyst review and check.
How often do you get a technical error or a non-technical error technical report?
How often?
Yeah, I'd imagine it's probably more often.
Fairly frequently. The big companies are really good. They have lots of geologists that write these things. So usually about early stage projects, where they only have one geologist. That's where you often see a lot more mistakes. And then we also deal with other issues where sometimes the text in the document is not a modern PDF. So if you look, anyone who uses a modern PDF, and that's what we're the text out, right? We're doing something similar to automated to pull up text off it, but sometimes people actually file PDFs that are just a bunch of images. That makes it really difficult to figure out what's there. Thank you.
Thinking about this from a technology standpoint, is there a, would you use this for, say, other uses like assessing if there's oil in the ground in a certain location?
Yeah, I mean, actually not just geological things, but in general. So one of our verticals that we're looking at is to focus a lot more on environmental type of metrics, which are becoming more common. So one model that we're trying to train on is looking at CO2 emissions. So there are specific reports, they're not filed by every company, but they're filed by a lot of the most important ones, about 400 of them. And what we're training them on to do is to look for what the CO2 emissions were next year versus what we got now. Just to try to build that out. We have the general perspective from an environmental sustainability ESG, right? So environmental social governance. I think we have a whole general perspective that the indexes are really not useful. And they actually are some ways pretty good. And so we're trying to focus more on, okay, well, from an environmental standpoint, what's the emissions, what's the energy use, what's the waste management stuff, what can we tell? From a social standpoint, what was the local employment, how much they procure locally? From a governance standpoint, can we pick up on things about what's going on? We try to package that as more data rather than packaging the index. And so we're in the process of building those models up and running, but we're looking to do it more directly because we call ourselves deep sector investment analytics, which means that someone like FactSet Bloomberg, they really focus on price data, your balance sheet, your income statement, that stuff. They're very good at that. They're always going to be good at that. We don't want to compete with them on that, but we think that we can take this approach to other industries and actually repeat this deep sector approach. The idea of combining data scientists with subject matter experts like geologists in the industry, but other verticals, healthcare, places where there's environmental stuff. We can even started looking at cannabis, which is a big one in Canada where there's a lot of mining companies that we deal with. The majority of mining companies in the world, of course, don't know, are listed on the Toronto Stock Exchange. With it being the biggest exchange and second is Australia. That's why a lot of the standards we talk about are Canadian and Australian, two biggest mining jurisdictions in the world. Mining companies that are listed on those exchanges go everywhere. And cannabis just seems to be the next thing for Toronto. It's where a lot of the cannabis companies that are being publicly traded being listed.
What's the competitive landscape look like for, like, specifically AI documents being fed in domain expertise, giving some sort of, like, I'd imagine it's a lot of people doing this, right?
Yeah. So a lot of the companies that do similar stuff are usually focused on sentiment analysis type stuff. So they're usually focused on maybe sentiments. There's a lot of companies out there doing those kind of things. Deep sector, there isn't, I think it's well as the new company or maybe oil stuff. So that's, we also try to steer very well. But those are the ones I know of outside of the industry. In the mining sector, there's not many people doing contextual analysis. Anyone I know of. I do know there's some AI companies doing stuff with deposit models where they use AI to look at where the next likely deposit is in the US. Right?
Yeah, I feel like the opportunity is to be the first to get the whole model of taking public filings, combine some sort of expertise, and then go and then say, okay, AI is going to run it, and you can do it across industries. I would imagine somebody, like, if you're the first to that, would be really exciting.
Yeah,
so there's not a lot of people.
There's not a lot of people doing deep sector. They're doing it in other ways. A lot of times people, like, I know that some of the big institutions like Bloomberg is like, there a lot of times they focus on the debt type stuff, and they also use it for like price predictions. A lot of times is what's being used. So analyst reports, there's a lot of people running AI on when the analysts publish the reports, they're running AI on that to see what the prediction is, and they use it to average those out to predict like the price level of the stock, and you compare it against the stock, and then look to use it as a buying tool or selling tool or shorting tool, I guess. there's a lot of that stuff going on. I think, the idea for us is definitely like what we're talking about is to really get good at the deep sector thing. Because I think it's the less initially sexy thing for people to look at, but it does have a lot of potential, especially as people become more interested, which I like to think that people will be moving in with maybe the relevant days, we're gonna see more fundamental quality research going into investors. That's it.
Maybe so. I came in a little late, so I kind of missed important this. You might have covered it, but I was a little curious about what does your current team look like? I know you've alluded to working with some data scientists, and kind of curious on what that technical team kind of looks like, and
So we have a data scientist, our head data scientist, Tatiana, based in Toronto. I do have an engineering team that's mostly based out of Kenya, with 2 resources here in Maine. We work a lot on the engineering side of things. Our data analysts, we have another one in Maine, and then we have a bunch based in India, Kenya, and one in the Philippines, and then we have sales net spread out in the United States. We're in the middle of a raise right now, so we're looking to expand our team in Maine. Is the goal. We're trying to go from 4 to 30 in the next couple of years. Hopefully that goes well. But that's what was kind of.
is it mostly data scientists that you guys are looking to recruit, or is it kind of a variety of different?
React front end engineer, definitely need that. I think 2 of them, looking for data scientists, technical analysts. We do a lot of our backend work with PHP, so probably look for a DevOps person who knows PHP. And then looking for a bunch of QA engineers. We need to offer testing what we're doing, and then more data scientists training models with well, we typically have taken that approach. We're under no illusions. We want to create jobs here that it's a little difficult to recruit talent in the valley. So our approach typically is to get younger engineers in and partner them with our more senior paying engineers as a more economical model. It's been pretty good at us. We're looking to try to expand that.
We did the same exact thing. Athena Health, my day job, and we built. It's not hard, right? Like it's a little bit of SQL. We built like over like probably 200 data analysts and use Snowflake, we do some ETLs. Yeah, I think you're spot on. It's just because the learning curve is so short for this stuff. It's smart. Yeah.
That's what we're looking for, and having all these data institutes right there, we're really excited about trying to find ways to work with that. Greater data systems. And it's been good for our Kenyan engineers, because our Kenyan engineers are quality application engineers, and they're actually really good at that stuff. But they have no experience in machine learning, data science, is really good way to extend their knowledge as well, while they work with some students that we got out of the local schools here in Maine. That may have more of the data science background than typical computer science. It's a nice career. We work across times and just difficult.
Who's your user? Like, is your user a finance person? Is it a mining decision maker?
It's a mix, and we have different subscription levels for this. So we sell data to some that there's the data provider. But a mining company, typically the big ones, what we're looking for are someone that sits in their what's called their M&A department and mergers and acquisitions. They're the guys working for the next company to buy, right? They are a key one for us because one, they don't pay $125,000 a year for some of the other software out there, stuff I talked about. And we create little tools to make their life easier. We're also, I hate to say this, but their UX is terrible. You use our app, and I do encourage you to go check out Prospector. It kind of looks like Zillow. You can actually look at their minds and say they look at their house in Zillow. So that's been really popular with those M&A groups, typically because they don't have a lot of resources. We also have a higher tier, like for the investment bankers. These are usually analysts that are covering mining companies, and they have to do lots of research. So we give them away research things, and that tool will actually direct computing in some like CB. Again, the type company. And then Tesla, the EV company, they're essentially looking. I don't know. You all follow Tesla is panicking about the lack of lithium and the reliance of Chinese companies to provide lithium. And so Tesla's putting a lot of effort in finding cobalt, lithium, and nickel that is not dependent on the Chinese markets. And so now they're starting to. I think you're seeing them in the news establish different agreements, looking to invest in mines and stuff, because they're looking to supply their own metal in the future, because they know that it's gonna be a shortcoming for their business.
Once you have a user, do they stay for a long time?
Yes. Perfect. Yeah, usually, we don't typically, we don't lose a lot of users. Usually they're, once they're in, typically they're, particularly, we're trying a new product right now, it's priced between $200 and $500. Depending on what they're getting in that product, it's a new thing for us. The old product was about $75 a month. That one was really easy, just to set up for people come back. $200 to $500, we're working on that pricing, playing with, see what makes the most sense, but in general, it's.
Given kind of the age of AI that we're in, and obviously Prospector represents that wave. What do you see coming next? That since you are on the cutting edge of that, does that give you more opportunity to explore new tools and new functionality? Or there, what the next 3 to 5 you see, how do we use AI more here to help this, whether it's customer facing, UX, et cetera, et cetera?
Has anyone tried chat GPT?
Yes.
So Tatiana and I have been going back and forth this a lot. I love chat GPT right now, just from a sense of like financial concepts I'm like trying to brush myself on, or for like total stuff. The one thing I think is lacking that we'd like to build on top of it, we're thinking about finding a way, how do we make ourselves unique? Right? How do we make a research process where maybe we make it free for someone to search like our own chatbot, kind of looks like a Google bar, we search and we say, okay, I want to know what mines are about to go into production that have gold resource in them and have a grade of such, right? Where they can ask that question, and we train a chatbot to do that, but with a slight tweak, right? If you can imagine if you're using ChatGPT, but instead of just getting the answer, you then have the link to the source, right? We can do that, right? Because we can train something to answer the question, and then we know where that source of that answer comes from, and we can push to that. So that's one of our big things. On a less serious note, I was just at a conference, and there was this guy who just came up to me because he was very fascinated about AI, but I think he's also paranoid. And he says, aren't you scared of what you're doing to train the AI, that the AI becomes sentient, that it's just going to realize how to get the metals and then just drive human society to just mine all the metals in the metals? He's a little crazy, but I'm just it's part of ethics of AI, we'll be careful, but I don't think we're anywhere near that. We do have a lot of human-centered AIs that we focus on this. It's everything's supervised.
One more, do you have any unsupervised learning that you're doing in this, or is it all supervised?
It goes through a loop. I mean, so it depends on the confidence interval. We just let it go through. So
Do you have a proprietary neural network that's learning, or is it? Okay,
we're usually building on other neural networks.
so your data company, not necessarily AI. Like you thought,
We're using, and we pick and choose the transformer models. So Facebook's fast text, which is one we use for usually like short names and stuff, and usually marketing methods. And then we'll use the Google's BERT or whatever, and GPT models to summarize a little bit better. By summarizing things where it's fast text is good about doing short pieces of text. So, yeah, we usually what happens is we identify a problem, Kathy and I sit down with one of our 2 of our data scientists, we figure out what the training stuff we use, we test the models, and then we don't deploy. It takes usually a month to deploy something develop data models.
What do you see as the opportunity for maybe a more non-traditional retail investor beginning to use Prospector as a tool to try to get into more retail?
Yeah, so
investment.
we actually have a free version. So if you go to the site and sign up, you can use the free version. And just it's a good way to just know. And that free version just like lets you know, okay, this is the mine, this is who owns it, these are the minerals, this is the staging of mine, right? Just the basic stuff. I think just knowing that can be also helpful, but also we have like a news service. So we actually have the only way that you can search all the filings for ASX and TSX on many companies in one place. So you can do an open text search. You get it from our cheaper service. I think that's one of the good ones. I think from an education standpoint, we're looking to add some stuff. I don't know if you use Robinhood, you ever notice there's like things about options trading and stuff. I personally have a big problem about the fact that Robinhood is promoting options trading to people, so they're responsible. So I'd like to see something where we provide trading on how to make good fundamental research into an equity to invest. Because one thing, even our investors, I had this investor 6 months ago, he said, I don't get it. I saw this drill result, it looked like a good grade, I put my money in, and I lost 3/4 of my money. And he said, what happened? I said, you didn't look at the drill result. So there's this thing that happens, right? This is one of our areas that we're looking into, it's called smear results. So if you can imagine those drill holes I was talking about, there are all these big lines, big drill holes that go in the ground. And those drill holes at each interval, there's a listing of how much gold or copper is at each level, right? If you take those intervals over a longer period, right, let's say like from meter 1 to 2 is like 50 grams per ton. And then every meter below that's like 0.5 gram per ton, by spreading it across 10. That looks like a really good mine by spreading over 10 meters versus that simple. But you don't know that unless you understand how to interpret that data. And so we're working on some ways, we don't do drilling data on our platform right now, but there's things like that where we're trying to inform investors that are, because that's your biggest benefit. You can get into a company before resource, that's where you're gonna make the most money in your investment, right? It's a time of the lowest value with the biggest return. But you gotta understand it's there, and there's a lot of people who get duped. Because the mining companies like to be very, I don't want to say this, creative in the way they report their drill results to get people to give them money to invest in. Right? So it's just, you gotta be careful.
Alright, how does somebody get started, like, real estate, you can buy a duplex, you get started, healthcare, you can have a single doc practice, you get started. How does a regular person get started in like do they buy a gravel pit? And then they're like, oh, I like gravel, and then they go, like, how does a normal person start this and then build an enterprise out of it?
Like
Start mining
company?
Yeah.
Yeah. So typically there's a whole tenement system that exists where you just claim a piece of land. In the US, a lot of our BLM land is for this. Usually you gotta be a geologist that's gonna have some sort of theory. Like usually you'll have, I mean, there's whole people who in all over the US and Canada basically buy pieces of land next to existing mines. And try to make money off, and that's one thing. Then there are people who are very sophisticated who know how to look at like large scale geological maps, form theories, look at abandoned mines, and then figure out what might be there and then drill. Because even drilling a hole costs $1 million, right? It costs a lot of money to drill a hole. So you want to know that you're drilling a hole for something, because if you drill a hole for $2 million and you're valued at $5 million, your investors are not going to be happy if you have nothing there, right? Because you just burn through all your cash.
My only thought with that is like if you knew that they got in on gravel pits or something and you had a product at $50 a month. My dad gets very excited about gravel pits. He's like, they pay for dirt. Like, yeah, whatever. So if you could have a product that like, somebody like my dad, there's probably like 10 million of my dad up there. And it could be like, oh yeah, you might be able to make some money on this. And use $50 a month for like pay dirt.
The only trouble is, and this is the big thing that is a problem for investment in the industry, is that Toronto and Australia are non-pay-for-flow investment, those exchanges. I don't know, for those who don't know, pay-for-flow is this mechanism that's set up where not exchanges, but clearinghouses get paid based on the number of shares they run through, instead of getting paid on the margin. And so what it does is it promotes large volumes, right? It's how Robinhood makes it, right? Pay-for-flow. And they don't allow that inside of Canada and inside of Australia. And so what that means is that any company that's listed only in Toronto and only in Australia cannot be on the trading. And it's very difficult to trade. And I think that's one problem. So, you can use E-Trade and those kind of things. So there's that retail investor. I think it would be, I'm against paper flow, so I feel like there's gonna be a way at some point to do it responsibly, where you can actually let these exchanges on that don't have paper flow. Because I think that would make a big difference, right? Because it's very difficult to invest in these early stage companies without them being on trading area, which is unfortunate. Good.
I feel obsolete as a subject matter expert in American literature.
That's right, I am.
But I,
Right, well, thank you, Jonathan, for your insightful presentation.
Thank you.
For those of you who would like more information on Prospector Portal, Jonathan's information is displayed on the screen. I'd like to thank our sponsors for this evening's conversation. This event is sponsored by CGI, Valley Beverage, Thomas Cultus Harold Alpine Institute for Business Innovation, and Brooks Co-working and Innovation Space. Thank you and have a great rest of your week.